Hello everyone, welcome to Blue Dragon Actual. So this video is related to, as you have seen in the thumbnail, the which policy or which product would have higher premium, endowment or whole life. So the last video that I made was, I am seeing some less views there, maybe because of people are traveling or people have exam, but I can see my subscriber base increase. And yeah, I'm thankful for that. But in case if you dislike a video, please go ahead and hit the dislike button so that I understand, right? Or you can also comment in the comment section, right? And if you like the video, please like the video, right? So if you don't do that, I'll not understand if something is wrong, if you're not understanding a concept. So I just wanted that feedback, right? And also, if you like the video, YouTube will share that video with many other people, right? So the more the like, the better it is for my channel. So that will also motivate me a lot. So in case you like this video or the any other videos in this channel, please like the video. Okay. So moving on. So first of all, endowment and whole life. So in any insurance product, there are two components, right? One is insurance, one is saving, and those are kind of captured in the sum assured. So for term assurance products, say for example, there is only insurance component, there is no saving component, right? That's because only when the person dies in a particular term, then you get the benefit, right? But for other products like endowment, whole life, there are both the component, insurance and saving. So just to give an example of what, because in fact in IFRS 17 also there are, like, they particularly try to distinguish between these two component, insurance component, and in IFRS 17 the saving component is known as uh, the investment component, right? So how, what is the saving component? So suppose you have a saving account, right? And in that saving account you have deposited, say, 1 lakh rupees, and the saving account is giving you 4% every year, right? So that is why it is called saving account. It means that you have lent some money to the bank, and the bank is giving you interest. So in this case also, so suppose you are paying 200 rupees premium. That's an hypothetical example, right? Maybe 2000 rupees premium. So out of this 2000 rupees, because you have invested in a saving product like an endowment or whole life, some portion of the premium will go for the saving component, some portion will go for the protection component or the insurance component, right? Now the portion that will go for the saving component, that will behave like a saving account. Say for for that amount, for that portion, you are required to be given some amount of interest, right? That interest is not fixed, that interest is not given, like it is not explicitly mentioned, but you need some amount of interest. But that's why that is only when it can qualify as a saving product, because you are kind of lending the money to the insurer, and the insurer has to provide you some interest, right? That's the basic component or basic concept of saving. So but there is no clear way to distinguish between these two component. Like if you are paying 2000 rupees, 1800 is for insurance, and 200 would be for investment. There is no clear way to do that, right? It's impossible to do that. Because your sum assured is cannot be split into an insurance and investment component, right? So that's why premium cannot be split. And that's why, like, IFRS 17 tries to make a decision between this. But I mean, obviously it's not that easy, right? So that's why only for saving product you have surrender value. For term product, there is no surrender value. That's because if you are spending certain amount of time with the insurer, the insurer is required to pay you certain interest, right? So how the insurer will pay you interest? Through that surrender value. If you surrender after, say, 4 years, 5 years, then the insurer is required to pay you some interest. And that's why for saving product, only for saving product, you will have surrender value. You will not have surrender value for term product, but you will have surrender value for whole life. You will have surrender value for endowment, right? So that's the overall concept, right? There are two components always, and that is kind of clubbed in sum assured. It's not clear how you can, like, segregate those two components. Now for endowment, right? The main risk, I'm talking only about the main risk. What is the main risk? Main risk is investment and mortality, right? For whole life, it is also investment. However, I've mentioned this as lower. Why the investment risk is lower? Because for whole life, you are supposed to, like, whole life usually is for, like, in India or any part of the world, it is for the entire life, right? So usually the duration or the term would be till 99 years of age. No, so whenever a person gets to 99, that is the coverage, right? So Actually you are supposed to pay premium till 99 years of age, but that is not how it works in practical situations. So there is something called limited premium paying term. So you pay your premium for a particular time period, right? And because of that, so suppose you are for a whole life product, you are actually, what you are supposed to do, you are supposed to pay say 2000, that 2000 rupees for 99 years, right? Or not 99 years, suppose you are taking the policy at 30 years of age, then you are supposed to pay that for 69 years, right? But instead of paying it for 69 years, that you are, the insurer is collecting that premium for you in, because of that limited premium paying period concept, maybe in 30 years. So the premium that is supposed to come in 69 years, that the insurer is collecting in 30 years only. And because of that, the reinvestment risk is reduced, right? Because after the end of 30 years, the insurer will get all the premium that the insurer is supposed to receive, instead of getting it at the end of 69 years. So the insurer can invest that entire amount, right? So the reinvestment risk is reduced. Why it is done? Because it is assumed that after a particular point of time, you're like, you will not have the ability to pay that much, like when after your retirement is near, you may not have the ability to pay premium, significant amount of premium at a regular duration. So that's why it is probably helpful if the limited premium paying concept is used, so that uh, it can be it can be uh, you, you, there is no pressure, and also the insurer have reduced risk. That's why I mentioned for whole life it is lower. But something like that does not exist for endowment, right? Endowment is usually for 5 years, 10 years, 15 years, 20 years. So I have not seen endowment more than 20 years, but there might be one. Like I don't know everything of endowment, so there might be some product like that. Personally, I've seen it for 20 years max, right? I have not seen endowment more than that. Usually there for 5, 10, 15 years. And mortality, obviously, right? So and all these are insurance products, so they are covering the mortality. So the question or the main risk for the insurer, like what an insurer wants, like for a particular product, like for a term product, is a very good product for the insurer, because the insurer may not have to pay, right? If the person do not die in the term, the insurer do not have to pay, right? But for this kind of product, whole life or endowment, by any chance the insurer has to pay, because if the person dies within the term for an endowment, the insurer has to pay. And I'm talking about the traditional environment, not the pure endowment. Okay. So if the person dies within the term, the insurer has to pay. If the person dies, if the does not die, then the insurer has to pay the survival benefit. For whole life, because it is covering the entire life, at any point of time you will die, right? That's a certainty. So at any point of time the insurer has to pay, right? So paying for this type of product, insurer has to pay. So the main, that is why the main risk for the insurer is the investment risk. Like when the insurer is paying, right? If the insurer is paying 20 years down the line or 10 years down the line, the insurer has kind of accumulated enough investment return. Well, but the insurer is, if the insurer is paying 2 years after, after the policy is taken, then the insurer is has not accumulated that amount of investment. It is a loss for the insurer, right? That's why investment risk come before the mortgage risk. That is why these are called saving product, right? And I've already explained the concept of insurance component and saving component, or insurance component and investment component, right? So let's consider a couple of scenarios. And yeah, one more thing. The reason I'm considering this question is because someone, I posted this video on, like, the link of this video on LinkedIn, and someone asked that question on LinkedIn comment section. And while I was trying to find that comment section today, or the comment, I was not able to, because it was mentioned in LinkedIn comment. That is one of the reason that I always mention, please write your comment question on the YouTube comment section and not on LinkedIn, right? LinkedIn is for a different purpose altogether. So don't write your comments or questions in LinkedIn. And from this point on, I will take a hard stance on that. If someone is writing or asking me some question about my YouTube videos, something else is a separate thing, but about my YouTube videos on LinkedIn, then I will not answer that question, right? I'll, because had this been on a YouTube video, it will be very easy for me to go to that video and find the comment. But for LinkedIn, there are so many comments, so many posts. It's very difficult to go back and track those comment. So but I think this will cover that question. So the question was related to which product would have higher premium, and there were some discrepancies. I've considered a couple of scenarios. The first scenario is where the endowment, as I mentioned, the term you of endowment usually is 10, 15, or 20 years. For whole life it is still 99 years of age, right? The sum assured in both this case is 15 lakh. right? 15 lakh here also, 15 lakh here also. Age of the policyholder is 28, right? There is no concept of limited premium paying term for endowment, but that concept exists for whole life, right? And that is 32. Okay. So the premium in this case would be higher for endowment and lower for whole life. Why? What is the reason? Because you are like the maximum term here is 20 years, right? 15, 10, 15, 20. So the premium would be discounted for lower amount of time, but here it will be discounted for 32 years, right? Because of that, although the premium is supposed to be same, in any case, the whole investment risk for whole life is slightly lower. So the premium is supposed to be slightly lower even for the same sum assured. And then it is discounted more, right? So obviously the premium for the whole life would be lower. And this is the concept based on which I made my previous video on which this question was asked, right? Now let's consider different situation. I hope this is clear, right? Till this point, there is no, if you have seen the previous part of the video, if not skipped through this video, then I think this concept should be clear. Now, scenario two, endowment, same term, 10, 15, 20, whole life till 90, 99 years. But in this case, the sum assured for endowment is 15 lakh only, but for whole life, it's tremendously increased, like more than three times, right? 50 lakhs, right? And irrespective of whatever, the thing would be, like for investment risk being lower in whole life or the LPPT, because the sum assured is so high, the risk obviously increases. Like for an insurer, as compared to paying a sum assured of 15 lakhs, paying a sum assured of 50 lakhs is much more difficult, right? So that means that the premium for endowment would be lot higher, for endowment would be lot lower as compared to whole life, right? That is because the sum assured is changing, right? So because the sum assured is changing, then the risk level changes depending on the sum assured, and the premium changes. And then this LPPT factor, the reinvestment risk being lower in whole life, that would not come into picture. The final scenario number three is, suppose an endowment has a term for 30 years, right? Rare, but let's consider the endowment has a term for 30 years, right? And whole life, obviously, we know it is for 99 years. It covers that age. And sum assured, he is 15 lakh. Once again, age is 28. LPPT is not applicable. So obviously for whole life, the LPPT is 32. I'm considering 60 as the retirement age. So even in this case, the premium would be slightly higher. Why? Because endowment has slightly lower investment risk, right? So a whole life has slightly lower endowment risk, not endowment. And because of that, endowment has such slightly higher investment risk. That is precisely the reason why the premium would be higher. It will almost be same. Like maybe one would be 2000, another would be 2500. Like whole life would be 2000, maybe endowment would be 2500, because they are covering the same risk, right? Investment risk is the main risk. They are giving the same death benefit, or the same benefit in that case, right? And that's why so in, even if the term is same, so if everything remains same, then even then also the whole life would have slightly lower premium. But if everything else, only in the scenario of where the whole life has a huge sum assured, then the premium would obviously be higher, right? So I hope this comparison between whole life and endowment is clear. Obviously this is learned by experience, it's not written in any book. And I hope from this point onwards, any question related to whole life and endowment, even the insurance component, investment component, which is a part of IFRS 17, is clear to you, right? So thanks for watching this video. Please hit the like button, right? Do not leave this video if you like this video, and if you have not hit the like button, please don't leave this video. And yeah, if you dislike something, please hit the dislike button as well, and please comment what I can improve. Thanks for watching, and see you in future videos.